Interest rates? There's something we all hear about. But do you know how they can impact your investments? When rates drop, your financial strategy might need a serious adjustment. What you might not realize is that lower interest rates can open up a world of opportunities, but only if you know how to take advantage of them. Today, we're going to reveal how you can make smart investments when interest rates are low and what you need to know to make the most of it. Let's start with the basics. Interest rates influence more than just loans and mortgages. They affect the entire economy, and by extension, your investments. When the central bank lowers interest rates, borrowing becomes cheaper, which can stimulate spending and investment. This can lead to changes in the stock market, real estate, bonds, and even savings accounts. But what does all this mean for you? Well, it means you need to be adaptable. When rates fall, your usual strategies might not work as well, and you'll need to adjust how you approach your investments. Today, we'll break down how you can turn falling interest rates into an advantage, and how to make decisions that set you up for success in this environment. A lot of people have misconceptions about what happens when interest rates drop. Many assume that a lower interest rate environment is bad for all types of investments. Maybe they think, if savings accounts are earning less interest, it must be a bad time to invest in general, right? Not exactly. Lower interest rates don't necessarily mean lower returns across the board. In fact, certain investment types can actually thrive in this kind of economic climate. It's all about knowing where to look and how to shift your strategy. If you don't understand the nuances, you could miss out on huge opportunities. That's why it's crucial to dispel these common myths and start thinking about your investments in a more nuanced way. So, what should you be looking out for when interest rates drop? Well, first off, understand that when borrowing becomes cheaper, many businesses can expand more easily. This can drive stock prices up, especially in certain sectors. Here are some of the main ways low interest rates can create investment opportunities. When businesses have access to cheaper loans, they can reinvest in their operations, expanding faster and increasing profitability. This can lead to a boom in stock prices, especially for companies that rely heavily on borrowing, like those in tech or real estate. If you're invested in stocks, a low interest rate environment could present an opportunity to ride the wave of business growth. Falling interest rates make mortgages more affordable, encouraging more people to buy homes. As demand rises, so do property prices. If you've been thinking about investing in real estate, now could be the perfect time. You'll likely see property values rise as more buyers flood the market. Plus, lower mortgage rates means you can secure financing at a better rate, potentially lowering your overall cost in the long run. Now, bonds typically don't fare as well when interest rates are low. That's because the fixed interest payments from bonds becomes less attractive compared to other investment options. However, if you already hold bonds, they can still be a stable part of your portfolio. Just keep in mind that new bonds issued in this environment will likely offer lower yields. Alright, now that we understand the basics, let's get into the specifics of how you can make the most of a low interest rate environment. It's not enough to know the benefits. You need a strategy. So here are the top approaches you can use to adjust your investment game. As we mentioned earlier, stocks and real estate can thrive when interest rates are low. But don't put all your eggs in one basket. Diversifying across these two asset classes can help you take advantage of market gains while mitigating risk. Look for companies or funds that are positioned to benefit from cheaper borrowing costs, and consider investing in REITs, real estate investment trusts, if you're not ready to buy property outright. If you own property or have loans with higher interest rates, now is the time to refinance. Locking in lower rates can free up cash flow that you can reinvest in stocks, real estate, or even a small business. Every dollar you save on interest is a dollar that can be working for you elsewhere. In a low interest rate environment, inflation can sometimes creep up, reducing the real value of your returns. Consider adding inflation-protected securities like TIPS, Treasury Inflation-Protected Securities, to your portfolio. These investments adjust with inflation, ensuring that your purchasing power is preserved over time. If you're finding these strategies helpful, now's a great time to subscribe to Sophisticated Saving. We dive deep into smart investing, personal finance tips, and strategies to help you make the most of your money. Whether interest rates are rising or falling, don't miss out on our future videos that can keep your financial journey on track. Now, let's talk about the stars of the show, the specific assets that tend to shine the brightest when interest rates drop. When bonds offer lower yields, dividend-paying stocks become more attractive to investors seeking steady income. Companies that consistently pay out dividends can offer a reliable income stream while still providing the opportunity for capital appreciation. Utilities, consumer staples, and telecommunication companies are often strong players in this space. Tech companies and other growth stocks often benefit from low interest rates because their expansion is often fueled by borrowing. When borrowing becomes cheaper, these companies can reinvest in growth initiatives more aggressively. This can lead to increased stock prices, making growth stocks a solid bet in this type of environment. When interest rates fall, investors often flock to tangible assets like gold and silver. These metals tend to hold their value when fiat currencies weaken, providing a safe haven during economic uncertainty. Adding a small allocation of precious metals to your portfolio can provide balance and protection. In any economic environment, but especially when interest rates are low, staying informed is critical. Markets can shift quickly, and the right move today may not be the right move tomorrow. That's why it's essential to continuously monitor how interest rates are impacting your investments and adjust accordingly. Stay updated on economic news, and consider consulting with a financial advisor if you're unsure how to position your portfolio. Remember, investing is a long game, and adapting to changing economic conditions is key to long-term success. To recap, a drop in interest rates doesn't mean doom and gloom for your investments. In fact, it can be a golden opportunity to adjust your strategy and grow your wealth. By focusing on stocks, real estate, and specific assets like dividend-paying companies and precious metals, you can turn this environment into a profitable one. Remember to diversify, stay informed, and take advantage of refinancing opportunities. The key is to remain flexible and prepared to adapt your strategy as the market shifts. If you enjoyed this video and want more tips on how to optimize your investments, hit that like button and subscribe to Sophisticated Saving. We're here to help you make the most of your money, no matter what the economy is doing. And don't forget to drop a comment below. We'd love to hear your thoughts on how interest rates are affecting your financial decisions.